Welcome everyone to the 5 minutes or less Essential Finance YouTube channel. Today, we are going to examine what qualifies a REIT as an income trust. Let's get right into it and, of course, let's finagle this bagel. The following criteria were established in the Tax Fairness Plan. Number 1. The 90% property test, which governs the type of properties a REIT can hold. It goes as follows. A REIT must hold qualified properties. It must not own more than 10% of non-portfolio properties. However, before 2011, it was 0%, meaning the REIT was not allowed hold non-portfolio property, but was later renegotiated. A non-portfolio property is defined as either a property that is used for a business or a Canadian resource property, where the fair market value of the property is greater than 50% of the REIT's equity value. A non-portfolio property is also the securities of a Canadian entity where the 1. The value of the securities are greater than 10% of the entity's equity, or the value of the securities are greater than 50% of the REIT's equity value. 2. The 90% passive revenue test, which governs how revenue must be generated by the REIT. The majority of the revenue produced by a REIT must come from qualified REIT properties and safe assets such as government securities and cash. At least 90% of the REIT's income must be from the rents or interest from real or immovable properties, or capital gains from dispositions of such properties, or dividends, or royalties. Basically, it ensures that the majority of their income comes from their real estate assets or from safe assets like dividends. Essentially, it prevents REITs from earning active income, meaning income from the REITs directly participating in the business activities. For instance, it prevents REITs from managing a property and the restaurant on that property itself, instead of just passively collecting rent from the restaurant owner. 3. The third criteria is the 75% real property test, which governs from what assets can the revenue come from. At least 75% of income must come from rents or interest from real or immovable properties, or from capital gains from dispositions of such properties, but not from dividends or royalties. If you're thinking to yourself, what? The second criteria asks that 90% of the revenue be passive. The third criteria asks that 75% of the revenue comes from rents or capital gains. Basically, they want 75% of the REIT's revenue to come from real estate. Next up, 4. The qualifying property value test, which governs the percent of the REIT's equity value that must come from real properties. Basically, it stipulates how much of the REIT's equity value must derive from the REIT's real property holdings. What it is saying is that the fair market value of all of the REIT's properties must be greater than 75% of the REIT's equity value. In other words, the REIT has to have collateral for real estate investors. The fourth criteria usually passes automatically if the first 3 requirements are met. Last but not least, 5. The public listing requirement, aka the public trading test. This last criteria was newly amended in 2011 and 2012 under the Technical Tax Amendments Act. It states that the units of a REIT must be publicly traded in order to qualify for the REIT tax exemption. This final criteria only applies to closed-end REITs because open-ended REITs do not have to be listed. If you found this video was informative, please drop a like below. Your support helps the channel a lot. Thank you.